It is 1 o'clock on the East Coast. We're in the convention center in this cavernous hall. We have jibs, we have cameras, we have sound people. We also have market call, and there's a lot going on here, Dan.
We're at the iConnections Global Alts Conference again, Guy, here in Miami Beach, sunny Miami Beach. What a day here, you know. Like, this is a pretty epic setup here. Yesterday, they had a full day of content. Some major market players, Mark Lazary, Steve Cohen, Howard Marks, David Rubenstein, Danny Moses was here. How about that?
It was
Steve
a great
Eisman.
day.
It was a great day, and we did Fast Money from here last night. We're going to be doing it again tonight. We got an awesome crew of folks here, right?
We do. And so let's do the docket for today, because we're going from 1 to 2 today.
Yeah,
we're sort of doing a collab. Elizabeth Young Thomas from SoFi will be joining us.
Yeah.
And if it's Wednesdays, Dan,
it's Butters.
Bitch, yes, it is. It's Butters. I'm excited. He's not in the flesh.
No,
it's Butters.
We got his
like
work,
he
but
sent us
you know who is in the flesh?
Elizabeth Young Thomas.
Elizabeth Young. Let's bring her in. Liz.
Hi.
Liz.
Hi, guys.
There
I'm so
she
jealous
is.
here in Miami.
This is her Super Bowl.
It's a balmy 40-something degrees in New York today. I'm sure
40
it's nice
degrees
there.
actually is a bit balmy.
Liz, when we left, I left over the weekend, it was like 17 degrees. So the 75 degrees here is welcomed, but we're on our way back tonight. Like I said, I always get this wrong, guy. I say it's Liz's Super Bowl. We have Fed Day, but there's 10 Fed days a year.
So it wouldn't be a Super Bowl.
It would be like
Super Bowl's only once a year.
Yeah, it'd be like the first.
It's like those bullshit,
divisional,
like Premier League games. Those like, what do they call those things? Friendlies that they play?
They do. But in between, but Liz, you would call this more like the wild card weekend. You know what I mean? Or divisional playoffs here.
So first of all, there are 8 Fed meetings per year.
Oh.
So I get this 8 times a year. It's like playoffs for all the different sports. I get playoff games for football. I get playoff games for baseball. I get them for basketball. I get it every season, all year long.
Yeah, but this seems like a sure thing. We've been tracking the Fed Fund futures. It's near 99% probability the Fed does nothing. I guess it comes down to whether it is going to be hawkish or dovish, Liz. I mean, where are you leaning? Because the last bout of volatility Monday in the markets was December 18th, when they had their last Fed meeting of the year. It was basically a hawkish pause. What's changed since then? What are you looking for?
Well, I mean, what's changed since then is we've gotten more inflation data, we've gotten PCE data and CPI data since then. And the CPI data, as we know, came in pretty much on expectations, not a big deal. We also have PPI data, which came in below expectations. So I think the market is expecting that the Fed isn't going to say much. I don't think they're going to say much either. I think they're going to leave a lot of flexibility open here for a couple of reasons. First of all, you are right to point out that market expectations right now, less than a 1% chance of a move. So we're not going to get any rate moves today. But we also know that it's more important what Jerome Powell says in the press conference than anything else. So for a couple of reasons, I don't think they're going to do much today or say much today. Number one, we are not even 10 days into a new administration, and we don't have enough information yet for them to really react to from a monetary policy perspective. We're still working on confirming cabinet members at this point. So I think they're going to leave a lot of flexibility open on that side. Number two, we obviously had the early week starting with a lot of jitters around DeepSeek, everything that's happening in tech. They don't want to look like they're reacting to what is occurring in the market. So I think they're going to stay flat. And we're still watching the economic data. We recognize that the CPI and PCE data that's going to come in for the first 3 months of this year is really important. They may, which is what they did last year, they may even start to say things like, we like to watch the data over a quarterly period. We want to see a trend in the data, and a trend is about 3 observations at a time. So they may even sort of push their eyesight out to say, don't react on a 1 month basis. We're not reacting on a 1 month basis. We want to see this over a 3 to 4 month time frame.
All right, Amanda, throw up a TLT chart. And Elizabeth, it's interesting. So yields traded up to about 4.8% or so a couple of weeks ago. And that top coincided with Scott Bessent, which, by the way, I think is a spirited, I think it's a great cabinet post, by the way. I think he's doing a great job. I want to put that out there. But also coincided with PPI and CPI, and we've seen rates go from basically 4.8 down to 4.5. So if you look at the TLT chart, you know, there'll be people out there, some armchair technicians say, you know what, that recent low we made about 84.80 or so looks a lot like the lows we saw back in October of last year. And then you're going to start to hear a lot of people say maybe a double bottom in TLT. So if TLT rallies, obviously it means yields go lower. I'm still of the belief, I want to be crystal clear, that yields are going to go higher. But how important today do you think, Elizabeth, is some of the commentary we hear and then the subsequent potential move in yields?
Well, I think it's very important. The subsequent move in yields, unfortunately, what we've gotten used to now as investors is that a 15 basis point move in yields is normal.
Yeah.
That's not normal. That should not be happening. So right now, because the market is only expecting somewhere between 1 and 2, we can call it 2 cuts this year, I think that there is a lot of opportunity for yields to move around, because if he says something that sounds more hawkish, right, then the market has to unprice even an expectation for 2 cuts. I've said this before on this program, and I stand by this. We were in a much more fragile position last year with monetary policy, in the sense that at this point last year, we were thinking that 6 cuts were coming in 2024. So the repricing that had to occur when the Fed became more hawkish and when inflation surprised to the upside for the first 4 months of last year, that was much more violent than I think what would happen this time, at least in equities. That correction didn't take hold until about April of last year. So what could happen this year is I think you continue to see the volatility in bond yields more than you see it in equities. So equities right now, and especially because of just the headlines that are going on this week, we've got mega cap tech earnings coming out, obviously all stuff out of China. The headlines in the equity market are distracted by the tech space, right? But the headlines that are going to drive the bond market remain the Fed and the data. And we know too that we're getting data on Friday, GDP data, we're getting PCE data. So bonds are going to react to that side of it. And I think that what we might start hearing again this year is that bonds know things before equities do. So Guy, to your point, if yields start to rise again, we know that before 4.5% on the 10-year was sort of the tipping point that sent equities in a downward spiral. I think the space between 4.5 and 5 will continue to be a dangerous place to be for the 10-year yield. And if it starts to creep higher again, it just layers on some of the volatility that might already be happening in equities for other reasons.
Yeah, so interesting, Liz, that you're saying that you think you're going to see more volatility than stock market volatility, equity volatility in the first half of the year. And it's interesting when we go back to, again, we're going to talk about December 18th and the stock market volatility that we saw post the Fed. We also saw a lot of volatility in yields. That's when you got the 10-year going up towards 4.8%, right? And then we think about what happened on Monday, that had a lot to do with fundamental news as it related to stocks, as it related to a big secular theme. So, Guy, as we get into the of mega cap tech earnings, we think generally we've seen a pretty positive trend starting out with the banks about a week and a half ago, and the reaction that we saw to the results and the guidance. And obviously, you know what, the banks have acted well over the last 2 years, really since SUB, when yields have gone down, when they've gone up, when they might go sideways for a while here. How much do you think fundamental news after today's Fed meeting, assume that there's no big surprises, does that become the big driver for the markets?
Yeah, banks, it's funny, we've been here now a couple of days, and the more and more people you speak to, the more and more people really optimistic and bullish on the entire sector. And that, I haven't really found anybody here over the last couple of days that is negative. I think I find myself sort of in the negative camp. I think a lot of the enthusiasm around banks started obviously into the election, the potential for deregulation, the potential for M&A activity, IPOs. People have gotten all excited, which is fine. Of course, the problem is for some of these banks, valuations on a price to book, like JP Morgan, for example, is stretched. The one bank I have liked, if Amanda wants to throw a chart up, is Citibank, and that's actually acted really well. So to answer your question, I mean, once we get through earnings, and it's going to happen a lot faster than people think, then the headline risk out there, I think, is going to be really interesting. The sort of tape bombs that we talk about are going to be coming fast and furious, is my sense.
And Liz, I know that you don't look at individual names, but you obviously look at the concentration. You look at the makeup of S&P 500 earnings, where a lot of that earnings growth is expected to come from, where a huge chunk of the whole earnings picture comes from for 500 stocks. When you think about the week we're about to have here, right? So this week we have Meta, Microsoft, Tesla, Apple, and then next week we'll get the rest of them, Google, Amazon, and a few others here. How important from here on out do you think that the guidance, it has to really be better than expected. It has to be better than whisper numbers, because my take on what happened on Monday, and I know you, Guy, and me were talking about it really at the infancy of that sell-off, right, on the DeepSeek news. It really feels like investors showed their hands in these concentrated trades, right? They didn't care about valuations until there was a fundamental reason to really dig down on them. So, is there a chance, in your opinion, that we continue to have the sort of price action we had on Monday, where you kind of had everyone head for the door at the same time, but the money did go into other sectors. It did go into other parts of the market. The S&P and the Dow massively outperformed the NASDAQ on Monday into the close.
That's right. And I do think that there continues to be potential for that. And the reason being is that we didn't find out on Monday that there was something wrong with the US tech companies. We just found out that the competitive landscape may have changed. We don't even know that for sure yet. So I think a lot of what happened on Monday was the positioning side of it. We had investors through December really piling back into a lot of those big concentrated names. We saw an index with a tech sector that was still deteriorating under the surface, but looked positive on the headline number because of those big names driving it. So I think you saw a lot of shorter term money piling into that trade again and piling into that theme again. But because the economic data is still strong, because the market momentum itself was still strong, and just this idea, sentiment, pro-growth, pro-cyclical, happy business environment is still there. And we were leading up to inauguration, and then inauguration had happened, and sort of without incident in the market, aside from maybe renewed optimism in some of those sectors again. You don't have investors wanting to head out of the equity market, right? You have investors looking for better valuation opportunities, because we know that that matters a lot this year, looking for fundamental strength, and I'll talk about that in just a second, looking for fundamental strength because we know that that matters a lot this year. We need earnings to drive stock market appreciation, and just looking for other growth opportunities. So one of the biggest beneficiaries of Monday's sell-off was actually healthcare stocks. You get a better valuation opportunity, you get growth opportunity in things like pharma and biotech, and you're in the large cap space feeling a little bit better about going to sleep at night because healthcare is technically a defensive sector. So we're seeing this rotation, and I'm already seeing articles popping up, analysts talking about the value trade is back, and financials might actually fall into that bucket too for a period of time. So I do think that there's going to continue to be this churn in the market out of some of those really highly valued tech names, but into other spaces in the equity market. And you have to make sure that you're thinking about what those spaces might be.
It's interesting, Liz, you were one of the people that were early, and typically early is wrong, but in this case you were right, that thought software really had a chance last year. And if you look, IGV made an all-time high in December. It had a pretty significant sell-off over the last couple of weeks, but now it's back on its horse. And now Dan and Liz, but I'll start with Dan, there are actually fundamental reasons to actually like software here, because if the CapEx cost or the CapEx spend is going to go down vis-a-vis what we've heard over the last couple of days, the companies that should win are the software companies.
Yeah, no doubt. So the cost of compute, like at some point, I mean, like if you see this situation where, they don't have the pricing pressure that a lot of hyperscalers thought they had because of the supply constraints as it related to the infrastructure build, the end markets, which is a lot of these software companies first, and they're going to be the ones that actually integrate this technology and then go out and sell it to their customers, right? If it's that much cheaper for them, I mean, then they become the ones with the pricing power, right? So I think investors figured that out pretty quickly on Monday. And I'll just mention this, the semi space, if Amanda wants to pull up the SOX, the SOXX, the ETF that tracks the semiconductor index, it's massively underperformed. That was Liz's point that you were saying all of Q4. That was a trade that she wanted to focus on here. It really never came back, despite the fact that you had a few names seemingly making new all-time highs for the back half of December into January. And, underperformance is underperformance. And when you have a sector that's so tied to a secular shift where valuations, you've seen this sort of expansion, at some point the chickens are going to come home to roost a little bit. I think that's what we had on Monday. And so then the question you have to ask yourself, is that a massive reset? Is that the point in which we can look back and just say, you know what, there's going to be a big digestion phase with the technology and the infrastructure, and therefore it has to happen in the stock market too? I'll just mention one last point here. ASML, ASML, a chip equipment maker, reported earnings. Let's pull this one up for a second here. And the stock's up 4% or something. It was up a lot more this morning. Look at that chart. Look at that huge down day in late October. They offered a bookings number going forward that was 50% of expectations. You remember that guy? And it had this massive move. So now the company comes in, they have a beat and a slight raise. That's coming off of a number that was cut in half from a booking standpoint. So when you look at this bounce today, that is uninspiring to me. So Liz, my question to you now, you had that software stocks sort of trade. The software sector has given a lot of it back, right? Is it time, if you see both of these sectors starting to just kind of go sideways to lower, that obviously, to me, looks like that's the way the tech sector goes in general.
Well, yeah, I mean, if you have semiconductors and software, I'm not sure what else there really is that's going to drive the tech sector anywhere. So if they're both going lower, yes, I think that is the direction of the tech sector overall. The software trade was really two-pronged at the time, and now I would even add a third prong to it. So the first prong being, if CapEx does have to shift, if it pulls back on where it's been spent by a lot of these big tech companies, because not only are they getting more criticized for how much spending they're doing, but maybe they've done all the spending now, maybe that's behind us, then there's more CapEx left for software. And that's a lot of why software had trailed semiconductors, because all the CapEx had gone to semis and not gone to software. Businesses had to make choices. So now if they're pulling back on some of the CapEx in other places, they've got more available for software. The next prong of it is that I think a lot of investors dug their heels in and decided, okay, this AI trade, the only place to win on it is semis, because that's where we are in the life cycle. But there's a next phase of the life cycle. Now, how do you put it into action? How do you actually use this as a company? You need software in order to do that. So the software piece is what's the next phase of that same life cycle, knowing that this AI life cycle is years long, not months long. And then I would add another element to this, knowing what happened on Monday, and that there might be some more fighting going on from a technology standpoint, from an IP standpoint, from a security standpoint between us and China. Add into that the cybersecurity side of this, right? You've got cybersecurity names in software that could be a really place to have an allocation if you think that this fight only heats up from here. So I still think that there's opportunity in software. Yes, they've given a lot back. When I started talking about this trade, and I do have it in my own portfolio, I'm about flat on it right now. So I watched it go up, I watched it go down, and now I'm sort of flat on where I entered it. But this is a time when I think having an allocation there and making sure that you're still not overexposed, digging your heels in on semis are the only winner here. You still want to be exposed to this theme, and I think software is the way to do it.
Yeah, and you've been right on that. I mean, obviously that move in Oracle sort of skewed things, and then it gave a lot of it back. But real quick, and I don't want to get sort of bogged down here, and we're going to talk about Nvidia in a second, but AMD was cut in half from February of last year, basically, and ASML was almost cut in half from May of last year. Now, you just mentioned the bounce, and I agree with you. I think it's somewhat feeble, and again, I'll say I think that's going to be somewhat short-lived. So all the sort of the pillars of this semi-trade, one by one, are being sort of knocked out if you look. And the only one effectively left, if you want to get down to it, is Nvidia, which if you want to throw up an Nvidia chart, and we'll talk about it, I mean, it had a nice day yesterday. It's given it all right back, effectively almost the entirety of the move back today.
Yeah, I mean, when you think about it, the fact that it gapped down, look at that moving average, that 150-day moving average, and that has been resistant since that gap. It gapped on Monday right to that point. Yesterday's high was right below that, and then today it hasn't even sniffed it yet. There's no way that the stock makes any sort of run for the rest of the day. It's down 6. I mean, I don't mean to be so certain, but it's down 6.25%. I think that as investors start to digest this news. It wasn't just DeepSeek. Alibaba came out and said they have a lower cost chatbot that is actually performing better than DeepSeek. Again, we don't know what these models are trained on. We suspect there was a lot of Nvidia chips. It's going to be harder to get those chips given some of the results that they've had, which is actually prompting the U.S. government. What is Lutnick, the Commerce Director?
I think so, yeah. But yes. And but we said what we've said for a while, what you've said, and I've sort of reiterated, competition is coming. Yep. We saw, it doesn't matter what I think about DeepSeek. It's clear that was the first salvo. What happened last night with Alibaba? There's a reason why Alibaba's had the move that they've had, because now they're sort of getting into the game as well. Amazon's getting, there are a lot of people that have entered this game because you know why? When they see a company like Nvidia enjoying 77% margins, they say, wait a second, well, how do we get in this? And I think that's what's happening. And, there are a lot of people that will say Nvidia has this huge moat, and maybe they do, and they have a 5-year head start. Maybe they do. I think what we've seen over the last couple of days is maybe the head start isn't as much as people think, and maybe that moat is not as wide as the market thinks either.
Yeah, just the last thing on this chart, when you think about a gap like that, this stock doesn't have too many gaps lower over the last 3 years. It's had a bunch of gaps higher. Those gaps then have been followed by consolidations and then breakouts, right? And I don't know why, if the fundamental news has changed and the trade remains still fairly concentrated. Look at that break of that multi-year uptrend, guy. I mean, at some point below this is the first time it's been below its moving average since mid 23 or late 22, excuse me. So again, this is like, to me, we talked about the fateful 8. Broadcom joined the Mag 7 in late December. This is the thing that causes the market to be either new highs or to kind of continue in a downtrend.
Elizabeth, days like today, you put your note out after the Fed, so we'll, I'm sure we'll drop it out in terms of our viewers and listeners at some point. But in terms of the earnings that we're going to see, obviously today we know what we're looking at: Facebook, IBM, Microsoft, Apple tomorrow. I'm not asking you to opine individually, but is there one company that sticks out to you, say, you know what, if they do really well or do really poorly, that could be a market moving event?
Well, I think all of them, honestly, and I don't mean to have a soft answer to that, but I think all of them could be major market moving events if they're way outside of expectations. I think what investors want to hear, especially this week, and here's the thing though, I don't know how much companies have changed their narrative since Monday, right? Usually you've got it all baked in already. You've got it all set up. You know what the numbers are going to be. Obviously, they can't change the numbers. They could change perhaps what they're going to say or acknowledge some of the stuff that happened on Monday. But I don't think any of the forces have changed really that much since December 31st, in the sense of investors still want to hear that companies are being more judicious about their spending, and or if they're going to continue spending so much on AI, that they are starting to generate revenue and they're starting to generate productivity. So I think that's still going to be one of the main tenets of a lot of what investors want to hear from these companies. The interesting part, I think, has been about Apple this week, right? That for a while, Apple got scrutinized that they weren't spending enough. And now this week, they look smart for maybe not spending as much. So I think there's a lot going on with the spending side of things that will continue to be the driver. I think today is a big day. I think Meta has a lot of potential to move the market. But again, all of these names have potential to move the market.
All right, let's talk about Apple for a second. It's our call of the day. It was downgraded. This is the second downgrade in the last 3 days. This is by Oppenheimer. I didn't know Oppenheimer's still in business, guys.
Sure, no. Danny Moses and all those cats.
I know, but that was 30 years ago, by the way. I didn't know they were still in business. So they're citing lower replacement share loss in China. Guy, you and I have been talking about this for a while. China's handset sales globally were flat in 2024. That's versus Android that was up 3-4% or so. So the way I think about this name, especially the way it's acted of late, I just think that the expectations now all of a sudden have gotten kind of high for something that's not going to see the benefit of Apple Intelligence, which a lot of investors expected to see in 2025. So to me, I totally get it. Guy, you and I were talking about this in late June. The fact that this company is able to license OpenAI technology, not to have had it invested in it, maybe like Microsoft, not to have the infrastructure spend like Microsoft to support OpenAI, they are going to be a beneficiary, but probably not in 2025. Thoughts into the print, and then we'll hit Tesla real quick.
I know Gene Munster was on OK Computer the other day, and I saw him on one of the CNBC shows, and he said he's very encouraged, very optimistic, and very bullish going into the print. We'll see. I don't share that, but he's been right. I've been wrong. Again, you go back to that June, I think it was June 10th. I think the stock closed around 193 that day, and the entire move to the all-time high, for me at least, was just multiple expansion, which has really been the story of Apple over the last couple of years, whether you like that or not. I think the average price target's about 246, according to FactSet. What's amazing is I still think there's a low on the street at $1.25, which is fascinating to me. But we'll see how it plays out. I'm still one of these people that believe, a back and fill, a retrace of that entire move from the summer is going to happen. And, we're starting to see it happen in some of the semis. And I think it's just a matter of time before we see it in Apple. I actually think that bounce we saw from the 220 level, which we flagged on the show a number of times as support, to these recent highs, is actually probably bad for the stock going into the print.
Yeah, no doubt. I feel the same. Let's look at Tesla really quickly, Liz, before we get to Butters. Tesla, guy, let's tackle this one here. The implied move is 9% in the print. I think these guys are going to miss EPS. I think they're going to miss margins, and I think they're going to miss deliveries. And I think that the real story is going to be how much of this relationship that Elon has with Trump in an interest rate environment that has actually been a massive headwind to them. How much are people willing to kind of give them a pass? Last quarter, the stock was up 22%. The last 3 quarters, you've had 12% moves. The quarter before last, down 12%, up 12%, and 4 quarters ago, you had down 12%. I think if all those things come to play, all of those misses, Guy, I think you have a stock that was at $200 right before the election, got as high as $490. Here it is at $390. Let's look at that chart here. It's in a very well-defined downtrend from those recent highs in December, and you see that uptrend that was just broken here. So do you agree on the fundamental take, and what do you think of the technical?
Well, I mean, I wish the fundamental take mattered. I mean, sometimes seemingly it does, sometimes it doesn't. I think this, if you look at the chart, to me, we're right at big support level. We bounced off this level a couple weeks ago. I think we traded back up to 420 or so, and then we're right back down to 390. I think margins, to me, if you want to focus on one thing, that's the story. I think the street is like 17.7.
I think they're a bit above that. I think they're like 18 and a half.
18 and a half.
Yeah.
Well, they're not coming in at 18.
Well, by the way, last quarter, they didn't have a huge margin improvement, or the way they did, it was kind of hard to back into. And so, again, it'll be interesting to see if you take some of that back. But you and I think this is the one on Fast Money tonight. Like, you and I are really excited to see.
I mean, if margins have a 17 handle, 17.8 or something, I don't think the street's going to like that much. And by the way, and again, forget about politics for a second. I think one of the existential risks to this stock, and not that it's going to zero, but it could really have a downturn, is when Elon Musk sort of wears out his welcome in his administration. And, as much as it has to do with him, it really has nothing to do with him. I mean, that's just been sort of the course of action over the last couple of, the first administration, now probably this one, where people just sort of wear out their welcome, some quicker than others.
Yeah, we've seen that movie before. Really quickly, the stock around 390, 40% implied, or $40 implied move in either direction. So you can do the math. I think it's 350 before it is 430. All right, if it is Wednesday, Guy.
Very exciting. I wish he was here. I mean, but you know what? Why it would be bad if he be here?
Why?
He'd be mobbed. We wouldn't be able to get him on the desk.
He's a superstar. Yeah. If it's Wednesdays, it's John Butters, Senior Earnings Insight Analyst over there at FactSet. He has his weekly email that drops. It could be in your email box. You know where to find it there. Where is it here, people? Oh, there it is, factset.com/insight.
A lot easier than the SoFi one.
Subscribe.
SoFi one is ponderous.
It's ponderous, but we love the SoFi blog here.
Of course we do.
All right, we just got to reset this thing.
Go ahead.
If it is Wednesday, it is John Butters. He is the Senior Earnings Insight Analyst over there at FactSet every week. He drops his report. It can be in your email box if you go to factset.com/insight/subscribe. Let's drill down on what Butters is focused on this week, Guy. It is rewarding positive EPS prints here, and obviously punishing negative ones. Let's talk about this. We have a chart that kind of is displaying some of the price action so far in this earnings season.
Well, it's interesting. So we had Vinny and Porter on Fast Money over the summer, and one of Vinny's edicts for the rest of the year into this year was make volatility great again, and we reiterated that last night. As I've said a couple times, I'm one of these people that think volatility is going to be a story. And when I look at this, I say, you know what? That's exactly what they're talking about. The companies that do well are being rewarded more so than usual. And on the flip side of that coin, companies that are not doing well are being punished. And I think you're seeing it in a much more, the chasm between the two is probably widening out, which speaks to me to volatility.
I actually think it probably changes over the next week because, again, the bar for some of these names, Meta, for instance, is at an all-time high, right? The enthusiasm in and around that, as you've seen money come out of some of the chip names, it's moved into there. Same thing as Apple. So I think the bar is high for some of these names. But, Liz, this is a stat from Butters here. S&P 500 companies reporting positive EPS surprises has seen an average price increase of 2.1%. The 5-year average is 1%. S&P companies reporting negative EPS surprises have seen an average price increase of a decrease of 2.8%. The 5-year average is 2.3%. Now, a lot of us, we get focused on those huge movers, right? You have an implied move of 8%, it goes down 12% or something like that. Talk to us a little bit of like how you factor this sort of price action beats, misses, that sort of thing. Is it important to you as you think about the markets in general?
It's absolutely important. And Guy used the point that I was going to make, is that it really feeds into volatility. And I think we have to remember, I want everybody listening to remember, volatility is not just on the downside. Volatility means how much something strays from the average. That's what standard deviation is. And a lot of times when we're talking about volatility in this industry, we're talking about standard deviation. So how big are the bands and how fat are the tails? That's what volatility is. So when we have days that see whiplash, and we've already had quite a few of that this year, that's volatility. So I think the other thing to think about in this context is, even if we're, rewarding beats more, punishing misses more, it also means that investors are paying closer attention and are more sensitive to the fundamentals and the earnings. And I think that that is actually a good thing. We don't want it to be so momentum driven. We do want investors to be paying closer attention to fundamentals and to earnings. But what that also means is that the multiple expansion that's occurred in a lot of places in this market is at risk if now we're looking at, well, do the fundamentals actually match up with the price movement that we've seen? So I think we're probably getting more rational with the fundamentals and paying closer attention to that as this year progresses. And I think that's a healthy place to be, but it will cause more volatility.
Yeah, and that's nearly a healthy place to stop. But I just want to make one last point. You're talking about standard deviation moves and the like, and a lot of that has to come. What are expectations? What is sentiment? The last point that Butters wanted to make here is positive price reactions to beats may be due to less pessimism on earnings outlooks for Q1. EPS guidance for Q1 has been more positive than average. Analysts have made smaller cuts to EPS estimates. So that seems that there's still an upward trajectory.
But I think that's typically the case, right?
Yep.
And so,
all right, let's, you know where to find John Butters, his earnings insight blog. It can drop in your email box every Friday morning, factset.com/insight/subscribe. Liz Young, Thomas, thanks so much for being with us here. You'll be back with Guy and me on the On the Tape podcast on Monday morning.
Thanks, Elizabeth.
So much, Liz. Go get them on Fed Day. All right, Guy.
Well, 1:30 now.
Let's do it.
Time for
Ready?
the show.
We're going to do a little reset here. This is the On the Tape podcast. I'm Dan Nathan, joined by Guy Adami on a Fed Day. We are doing this podcast right before the Fed statement that's going to come out and then the Fed presser afterwards. Guy, there is nearly a 100% probability that the Fed will not move the Fed funds rate. Thoughts on expectations into the print? The last time the Fed met was December 18th. We saw a lot of downward volatility immediately after what was a hawkish statement.
Yeah, well, it's interesting. We had a GDP revision this morning, which I think sort of surprised some people. As a matter of fact, I was listening to Carl Keaton-Nia this morning, and he said, I thought that was a misprint. He had to look at it again. But maybe that was due to the fact that a lot of people were shipping their goods ahead of potential tariffs. So maybe that's just a one-off. With all that said, 0% chance they move at this meeting. I think we all agree. The market does as well. It's sort of the commentary, and the Q&A is, to me, is that's going to be as fascinating as you've seen in a long time, because my sense is one of the first questions he's going to get is, President Trump has talked about the want and the need for lower interest rates. What are your thoughts, Fed Chair? And I think he's going to have to address that probably from a number of different angles. I'll say this, if you're looking at it, the fact that 10-year yields went as high as they did on the back of the September cut, when they started cutting, yields went from 3.6-ish almost to 4.8. Never has happened before in that time span. I think that's probably got them a little concerned. So I don't think they're going to be as dovish as the market probably wants them to be. I think they're looking at this re-steepening of the yield curve and as quickly as yields went higher as a bit of a cautionary tale. And there are people out there that think if there were just lower rates, it's going to lower 10-year yields. No, we'll do the exact opposite.
Yeah, you know what's fascinating? So a lot of you folks, they love the 0 days to expiration options, and they probably love them the most on Fed days, especially in the major, sector ETFs or indexes. And when I think about this, I look at the VIX, maybe Amanda, well, it's not going to be Amanda. Let's look at the VIX, Guy. You were talking about that move on Monday that we saw up to about 23. Here we are. We filled in most of that gap. It's about 17, so it's a little bit elevated on a down day into the Fed. The implied movement on today in the SPY is less than 1%.
Yeah.
I think there's a pretty good chance that we're going to have more than a 1% move between the Fed statement at the end of the day. And I just want to be really clear with the SPY at 602, if you have a $4 implied move between now and the end of the day, the idea of realizing $4, I think is pretty good on either direction. Let's say you don't know which way it's going to go. The flip side of that, $2 if you want to buy the call, or $2 whether you want to buy the at the money put. I think you get one of those if you have any conviction whatsoever. I just don't see the likelihood of a flat day between now and the end of the day.
The market's got so conditioned to watching vol spike and then watching it come right back down, and there's so many participants that have made a fortune by selling volatility on up days, and I think to a certain extent that's what we're seeing. I mean, the people have been complacent on that front, and what you just described speaks to exactly that. If you're asking me, which you clearly are, I mean, you could have clearly one of these Fed days where the market rips, the Dow goes up 350 points, and then by the end of the day, it's, down the exact amount, or vice versa. We've seen that before. I think it's a potential to see it again, especially during some of the Q&A stuff. So I'm not shocked. I'm not surprised that that volatility in what you just described is as cheap as it is, because the market's been conditioned to be sellers of vol on any spike, and they've been rewarded for doing that.
100%. I mean, and again, going back even to that December 18th day when you saw that big downward move in the major indices in the equity markets, and you saw that big vol spike, but you've said it again and again, those have been really good opportunities. Let's talk about earnings here. By the time many of you are listening to this, we'll have already been through Microsoft, Tesla, and Meta, all reporting Wednesday after the close. A lot of big implied moves. They've moved up a bit, week over week since that Monday price action. Which of these guys are you most closely following if you think the major secular trend that has benefited, stock market gains or been a big driver of stock market gains really for the last 2.5 years right now? And if we think that it's at an inflection point, which are the names you want to focus on?
Microsoft. I think they're all important. But if you look at Microsoft, I mean, they're sort of at the epicenter of everything we talk about seemingly on a daily basis. A stock that, quite frankly, has gotten itself pretty expensive. A stock that since June or July hasn't done all that much with the broader market making all-time highs. We're within, 1.5% of an all-time high in the S&P. So Microsoft, to me, is sort of at this bit of a crossroads here. What are they going to say that's going to reinvigorate that stock? Is it going to get people excited again? Is it going to be reacceleration of growth in the cloud? I'm not sure, but to me, if there's one that's going to dictate the market over the next couple of weeks, it's Microsoft.
Yeah, so this one's really fascinating, right? So if you want to go back to the start of 23, they had invested in OpenAI. This is a company that a lot of folks outside of tech was not particularly focused on, private company. They announced their ChatGPT 3.5 in late 2022. That got this whole thing going, the way in which it was kind of operating relative to all the other chat bets. Prior to it, Microsoft had invested a couple $2 billion. Then they went in with $10 billion. Part of that investment had to do with the fact that they were going to have some exclusive access to this technology so they could kind of build it into their products and services. But they were also going to have the benefit of OpenAI further training those models on Microsoft Azure, so on their cloud. So it looked like a great deal. Microsoft was trading very well. The stock made an all-time high guy in July. It got near, 470. And then between early July to early August, the stock went down from 470, I think as low as 390, and that was the big reversal day. And since then, it's really lagged the broad market, the S&P and the NASDAQ. I'll just say one last thing about this OpenAI-Microsoft relationship. If you've been keeping a close eye on it, it's been fraying over the last 6 months or so. And so, if OpenAI were to kind of pony up with one of Microsoft's competitors in the cloud, that would be something that I think would be a problem for Microsoft. And the last thing I'll just say here is that the company put out some CapEx guidance, I want to say a few weeks ago, $80 billion. Again, they said half of it's going to be here in the U.S. With some of this regulatory sort of situation and the government kind of focused on this and DeepSeek right now, it'll be interesting to see if they raise that number or lower that number. And I think that's going to be a big driver again.
Without question, I'm laser focused on that because I've said it a number of times. It's not one of the 3 most important companies. It's definitely one of the 5 most important companies in the world, given all the different things they intersect, without question. And quickly, if you're just looking at some of the other stocks that I think are really important, if you want to do the top 5, I think Taiwan Semi's got to be in the mix as well. And I only mention that because very quickly you've seen a 10% drop in Taiwan Semi over the last week and a half or so, and that's sort of coincided with its move we're seeing Nvidia. So If the semi trade starts to break down, which it seemingly is doing, what does that mean for the broader
and again,
market?
I mean, everyone's known this. This is why Nvidia has gone from a $200 billion market cap, I want to say about 2.5 years ago, to just $3.5 trillion coming into this week. And that was the most valuable market cap company in the world before this huge drop. And I just kind of put it in context, Monday, Nvidia was down 17%, closed on the low. Yeah, it had a bounce on Tuesday, but here we are Wednesday afternoon, and the stock is down 6%. So from a technical perspective, from just the kind of volume that is traded over the last 3 years, today's a really important day. To Taiwan Semi, if Nvidia has 85% of the high-end GPUs that go into the servers, that go into the data centers, that train the models, Taiwan Semi makes up 85% of the manufacturing of those GPUs. So it's a really easy thing to kind of connect those 2 dots. And then the last thing I'll just say is like ASML, that makes the equipment that makes the chips. They reported on Wednesday morning. Now, guy, help me make some sense of this. Remember that huge down day it had in late October? The company ASML reported their bookings number was 50% less than what consensus had, okay? So all of a sudden they report Q4 today. You ready for this? The bookings were up a lot more than they expected, right? And then going forward. So you can't cut a number in half and be that dramatic about it and then have some smaller beats and try to take a victory lap.
Well, that's exactly what they're doing. And I think some of these pundits were trying to do the same thing. But this is a stock that was $1,100 in July. And I think it almost was cut in half into the fall of last year. And now we're getting this bounce. This bounce is not that inspiring to me. I mean, I get it. People are excited. You're getting this bit of a relief rally, but I don't think it changes the course whatsoever. So, yeah, it looks good today, and people are sort of, to your point, taking that victory lap. But look in the context of what this is where it's been. And real quick in terms of Nvidia, because I do think it's somewhat important, we've become so sort of desensitized. Company lost $600 billion of market cap on Monday. $600 billion. How many companies in the world are that big in the first place? A handful. And, they're just numbers now to people, but that is a staggering thing to me.
No doubt. I mean, it just speaks to the concentration. It speaks to the huge gains that investors have had. And if you kind of came into 2025 and you were sitting on 185% gains in just 2024 on Nvidia, it's not going to take much for you to think about taking some profits and trying to find some other trends to redeploy that capital within generative AI. There's lots, and you and I have been talking about this. And, Vincent Daniel yesterday, I think on Fast Money, but he definitely did it on the session here at Global Alts. That's where we are, by the way, if you're listening to this right now. CNBC is recording our Fast Money here. This is where we're doing the podcast, but this is the iConnections Global Alts Conference. There's 5,000 people here. So Danny, Vinny, Porter, Steve Eisman were being interviewed by Melissa Lee. And I think it was interesting because you and I have said this. The next trade in the generative AI is the use case trade, right? It's the software companies that are basically able to integrate this technology into their products and services, right? And kind of whether you're a SaaS company, grow seats and the like here. And then what are they selling to? They're selling to all the other sectors outside of technology. You've used the example of Walmart increasing the pace of their e-commerce. These are the sort of use cases, and that's probably got the next leg of this trade.
Well, that's why Facebook is so interesting because, if you think about it, the next iteration of them is the margin improvement. Listen, revenues are probably going to be declining, which is fine. Their earnings are probably going to accelerate because of AI and because of what it's done for their margins. Without question, Walmart is the same thing. But what's interesting and what you talked about, it's never different this time.
Yeah.
These chips do become commoditized, which then hurts margins, which theoretically hurt the stocks. But it's great for software companies, to your point, because their costs just went down significantly. So Facebook should theoretically win to all this. And, they're going to talk about the spend. They've talked about it before. I don't know what the market's going to do that, punish them or not. But what I am focused on is continued margin improvement for them on the back of what you just talked about.
Yeah, coming into earnings, the stock's up 15% on the year. It's very near an all-time high. I think that one of the things we could take away from this DeepSeek, data that we saw late last week into this week is that it is an open source model. Okay, that is what Llama is, that Meta has spent, the last few years training. That's the thing that has actually benefited their business internally, the way they serve ads, the way they monetize, a whole host of other things. I just wonder if that's in the stock. And we just talked about Microsoft, who's given that CapEx guidance for the year. So did Meta, and it was 65 billion minimum. That was 2 weeks ago, I think, or a week and a half ago when they said that. Let's see what they kind of speak to now, Guy, whether they ramp it up or whether they actually tamp it down. Because if you have two open source models that are competing with each other, I think Alibaba said the same thing about their model. You have the ability, if you're a developer, to take bits and pieces of that code and kind of build on top of it. So I think what Meta has to say, what Mark Zuckerberg in particular has to say, and again, this goes back to his proximity to the new administration, right? Satya Nadella, I don't think was at the inauguration like some of these folks were. So let's see what the Microsoft and the Meta have to say. All right, this is to me the main event. This would be the Tesla. Okay, by the time you're
I know it's your main event.
Well, it's kind of my main event, But here's the thing. I just want to go through expectations a little bit, right? So last quarter, the company surprisingly beat. They missed on deliveries. They had better than expected gross margin. The delivery number was horrible. You and I were sitting on the desk of Fast Money that night, and we're like, how is this stock rallying based on that BS GM beat? Okay, but the delivery miss, and I think earnings were even missed. So right now, FactSet consensus for the quarter is 77 cents on a non-GAAP basis, and basically, that's analyst consensus. I think they missed that. Okay, why? Because I think margins are going lower too. And I think analyst consensus for gross margin 18.6%, and maybe it comes in below. I don't know, man. If it came in at 17.6 or lower, what's the stock doing given the rally that the stock has had since the election?
Well, you'd see it'd be another deceleration in margins. It was about a year and a half or so ago when we thought we got to trough margins, and they spoke to that. And they said, Elon Musk said, our margins are going to decrease, but we're not going to get down to legacy auto margins, which they basically did wind up getting down
100% did.
And then you saw a subsequent bounce in margins. People say, that's the all clear sign. Here's the reacceleration. But to your point, if we were to see anything with a 17 handle, I think, would just suggest, they have a problem on the margin front. And so much of that story, I think, is predicated on them being able to hold their margins, and they're not. And if deliveries continue to go down for whatever reason, and if competition is out there, which it clearly is, and then all the other input costs, which haven't been going down, I don't know how margins do better.
Yeah, on a sequential basis, we're supposed to see about 19%. That was down from 19.8. That was the largest gross margin the company had since 2022. And just to be clear, in 2021, the company posted
23 and a half. It was 25?
25.
Okay. I was close.
Yeah, no, it was. And I just that was the year in which they said their margins are not going to get down to traditional autos. And, just to be clear, if you just have a chart package in front of you, you can look at this thing. The stock topped out at $400 in late 21. It got as low as $100 in early 23. The stock, as of November 6th, was trading, or just before that, I guess you want to say September, October, was trading around $200. This was one of the worst performing stocks in the entire S&P 500 that had a market cap above $500 billion. And then you see this stock go from $220 up to $500 nearly because of, Elon Musk's proximity to the president. Now it's come in, obviously, it's trading $390 here. I think if they miss EPS, they miss deliveries, they miss margins, this will be fascinating to see how this stock trades if all of that stuff on the political front can outweigh what's going on in the fundamental front.
My sense is tonight on Fast Money, we'll spend an inordinate amount of time talking about the stock reaction in Tesla one way or another. And I'm sure somebody will come on to defend, somebody will come on to talk about the flip side, but it's a name that it fascinated people for a myriad of different reasons. But I don't know, though, and you may disagree with this, I don't know how important Tesla is to the broader market sentiment. I think at one point it was. I'm not sure it is anymore. Okay, but we keep hearing about the Trump trades. This is of all the Trump trades, it's on the top of the list.
This is on the top. The stock, at its highs just recently gained $750 billion in market cap on nothing fundamental, on the hope that the proximity of the CEO to the White House was going to cause further deregulation that will allow them get closer to full self-driving, which will allow them to get to robo-taxi. I think that robo-taxi is a pipe dream. Whatever you want to give me, this the over/under.
Well, that's been the carrot.
I'm taking the over.
It's interesting, and that's what they seemingly throw out there when the stock is in trouble in terms of a downward trajectory. They throw out the robo-taxi, and it's coming. And it's a carrot. It's the horse and carrot thing. People run towards that, and it happens every single time. But at some point, it's you got to sort of come up with it. You got to fulfill your obligations. Otherwise, the market's going to start to discount the rhetoric.
Yeah, and we haven't even mentioned China. Okay, so half of Tesla's cars are made in Shanghai, and half of those cars, if they're not sold in China, they go to Europe. Europe has already placed some pretty substantial EV tariffs, okay, on Chinese automobiles. You know, Trump obviously keeps threatening big tariffs on China for any sort of product that's made there. So to me, I think that, you know, Tesla is in the, you know, it's in the middle of this trade conversation. It's in the middle of just the way you think about the pricing of these cars. I mean, China has, you know, obviously underpriced Tesla cars. They look very expensive in China. So that'll be interesting. And the last point I'll just make there is, do the Chinese start to have some real nationalistic tendencies about their purchases as a lot of this rhetoric gets dialed up? Guy, which leads me to Apple. There were some reports out that their Chinese business is down 18% year over year. This is a company that under the first Trump administration, I think Tim Cook pretty masterfully had a bunch of their products carved out of a lot of the trade situation, a lot of the tariffs. They report Thursday after the close. Talk to me about this one. Do you think that other than Microsoft for the broad market, is this one as important?
You know, it's interesting. There was a period of time a year or so ago where Apple was not performing well. And, you know, historically, I've said as Apple goes, the market goes. But as it turns out, I mean, Apple was a complete underperformer in a stock market that was doing really well. That obviously changed in June when the stock went from basically 190 to 240 in a straight line post that developers meeting, whatever they called it. But to answer your question, yeah, I do think it's important. You know, Apple wins to basically one thing, in my opinion, one thing only. They're in over 470 ETFs, I think, of which 415 of them have Apple as a top 15% holding. So as passive money comes in, and last year to the tune of $1 trillion, the biggest beneficiary of that is Apple, without question. And the move that we saw since June to the recent high is all multiple expansion, which people will say is justified because they're in the catbird seat and their services business is now a bigger percentage of overall revenue, which is the reason why they get to multiple. I get it. But you know what? At the end of the day, they're still selling things that people have to buy, and they're still sort of subject to the economic conditions that people are facing right now. And I think that entire move from June is going to be round trip. That's not today or Thursday or Friday, but at some point.
Well, it's interesting that you just said have to buy. And that's been a big part of the bull story in the back half of last year, is that there's like, I don't know, hundreds of millions of iPhones around the world that need to be upgraded because the batteries start leaking, you know, all this sort of stuff. You get to 3 years, and that's what happens. The problem is the product that they released at the Worldwide Developers Conference on June 10th was Apple Intelligence, and that was meant to kind of spurn that sort of upgrade cycle. That's why all the analysts in the street were going crazy. That's why the stock went up 10% in 2 days. You and I were not of that belief. Everything that I saw coming out of that in what was going to be a staggered release of that product over the course of the year, there was no reason to run to an Apple store to upgrade your phone in September and October. And that proved to be true, right? So when you think about that, what is the upgrade cycle? When does it happen? Well, first things first, if the Apple business in China is so bad, Apple Intelligence will not be in China, especially when you think about this DeepSeek news. I think there's a really good chance. So we talk about some of this political rhetoric, we talk about a trade war, you talk about nationalistic buying tendencies. Well, it all fits with Apple too, right? So if you're a Chinese consumer and you've been spending or paying up for an iPhone over the last, call it 5 years or whatever, and all of a sudden now you have this AI bot that you can download on your phone, and it could be an Android phone that's probably a third of the price of an Apple iPhone. You have a WeChat super app. All of a sudden you're like, wait, do I need to buy this sort of thing?
I mean, the only reason to buy it is because your battery dies and you get sort of tired of you looking at your screen that's broken. I mean, quite frankly, but you know, there is going to come a point where these are not cheap devices. And if you believe the economy is slowing, if you believe the consumer here in the United States is becoming exceedingly strapped, which a lot of these data suggests that they are in terms of credit card debt that's out there, total household debt that's out there, Apple doesn't win to that. And when passive becomes active, it's never active on the way up. So I just say sort of get ready. Full disclosure, you had Gene Munster on OK Computer the other day. I think he's really optimistic about this print. He's very bullish on Apple, and he's been right.
Yeah, I mean, the move that we saw from late December 260 down to 220 just last week, and we were talking about why did Apple act so well on a relative basis to other mega cap tech stocks after that DeepSeek data came out, is because they haven't spent tens of billions, $100 billion building out the infrastructure. They got to license it. So again, Apple, it kind of ran a lot to 240, not a buyer here.
It's in, going back to Tesla, but General Motors had a 10-11% move this week to the downside. And again, I'm not suggesting that's going to be any sort of causation for Tesla, but just sort of put it out there. I mean, there's still, the auto sector in general is still having their issues in terms of the stocks. So just keep that in mind going forward into that print, because I do think it's going to be interesting.
Yeah, so early next week, we'll hit Google on Tuesday after the close, Amazon Thursday after the close. But again, by the time you're listening to this, I think we're going to know a lot more. Microsoft CapEx, any tweaks to that? Meta, the same thing. And then Apple, this is a big one, obviously. I mean, I think it's a lot of Apple-specific stuff. And then Tesla, to me, purely as sentiment about the Trump trade.
Fair enough, and we're going to find out. So, I mean, that's it. A lot to look at. We're going to have a Fed presser now in the next couple minutes that, again, when you're listening to this, it'll take place. But interest rates, to me, before we get out of here, to me, that's still the driver. We saw from 3.6 to 4.8 in the 10-year over the course of maybe 5 or 6 months. Subsequent move back to 4.5. I think we're going to sort of find a floor. I think rates are going to reaccelerate to the upside. I don't think the market's going to like that. And that's one of the wild cards for 2025.
Yeah, I guess the other wild card is what sort of pressure the White House continues to put on the Fed, right? So if the Fed comes out here, and they got a tough, wire to kind of walk across right now. So they got to talk about this DeepSeek and what it means for the generative AI trade. I mean, there's just a whole host of things they got to do. And if, for instance, it's a bit hawkish today, what is the White House saying about this?
Well, the difference this time, the first Trump administration in 2018 in the fall, Jerome Powell was in the seat maybe for 3 or 4 months-ish, right? So he was new at the game. I think he was learning. He had the market working against him. He had the administration sort of beating him over the head every day. And I think he acquiesced. I think it's a much different Jerome Powell now 7 years later, and I don't think he's going to be subject to the same pressures. I think he's better equipped to handle it.
Yeah, no doubt. Well, I think this is going to be one of the first big battles that we see out of the White House with kind of this, apolitical sort of, organizations that are supposed to exist in our government. But we will see. So, Guy, you and I are going to be back on the market call tomorrow. That would be Thursday at 1 p.m. We're going to be previewing a bit more of the earnings. And then on Friday, Friday's drop is going to be pretty epic. We have Melissa Lee interviewing Danny Moses, Porter Collins, Vincent Daniel, and Steve Eisman. That was a great conversation.
It was a great conversation.
So that'll drop.
That was a half-hour conversation. It could have been an hour and a half.
Oh, my God.
I mean, those guys are really interesting, and Mel does a great job. So I want to thank everybody for joining us. We'll see you tomorrow, 1 o'clock on the market call.
Yeah, it's been a great couple of days at the iConnections Global Alts Conference. We killed it here today.
Well, I don't know about killed it.
Yeah,
we did okay. And you got to give a shout out to this. I mean, we have so many crew members out here. We have at least 6 guys that have done an amazing job. So thanks to them, because they've been with us the last couple of days.
All right, we'll see y'all.